The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed.
Welcome to the final stock take of 2021. My name's Gaurav Sodhi, and joining me for this momentous occasion is, I think for the first time in the year, possibly, is John Addis. Hey, John.
Hey Gaurav, how you doing?
I thought I'd give you a really big, eventful intro, but I'm not
It's
sure.
all downhill from here, I think.
It is, isn't it? Yeah, I think that's the problem. We probably peaked. Oh, and we haven't peaked yet because we've still got to introduce James Carlisle. Hey, James.
Hey, how's it going?
All right, now we peaked. That's it. It's all downhill from here.
Turn it off, Steph.
Gents, what a year. Look, you probably can guess what I want to talk about because I whipped everyone in top three
So
for
far,
three.
1/3 of the way in.
Yeah.
James, I didn't want to point this out, but I am double what the next closest person is. You're not going to catch me. No one's going to
Pride
catch me. I'm
comes
the runaway with
before
this
a
one.
fall.
It does, doesn't it?
That's right.
I'm being a
Does
bit
that make up?
facetious because
Didn't you come last in the one before?
horribly
obviously?
last,
Yeah.
and
Yeah.
last by a mile. In
comes
fact, I
before
lost
pride.
money last time.
I think we mentioned that.
Yeah, no, I think there's a real strategy to this game as well. It's not just about picking the best stuff. You got to lean into the right amount of risk at the right time and balance the three things out. I think I've got this down now. I know how to do this. I think from here it's all going to be plain sailing.
Jeez.
But apart from me winning year one and all, the other thing I wanted to talk to you fellas about is just what an extraordinary 18-month period we've had, and the results from top three of three for year one, I think, demonstrate that to some extent.
Yours
JC,
do.
sorry, John.
Yours do, I think.
Well, yeah. I mean, it's been. I thought when we went through the GFC, I wasn't working in the business. I wasn't a professional investor, but I was investing my own money. I thought that would be a once in a lifetime sort of experience. We'd never see a drawdown or a rise quite like that. But here we are, just over 10 years later, and we've had something similar. What did you make of it, John? Was that? I mean, you've had more experience than me. Is that something you kind of prepare for?
No, not at all. I mean, it was just hard to imagine how rapidly it came and then how rapidly things came back. And I remember we actually had a development session on I think
That's
it was
right.
March the 23rd.
That's right. Never forget it. Yep.
And I was out getting scans done on the Gold Coast and dialing in to this development session with Greg Hoffman as a former research director. And he was talking about Centre, I think, and he was saying, this is it. You know, this is another GFC. We didn't expect another one of these in our lifetimes, but here it is. You know, 10 years later, we've got another chance. If you're not acting now, then what are you doing?
Yeah.
What are you doing?
Yeah.
And turned out to be absolutely right. And we've done pretty well from it, but I'm just amazed at how quickly things have turned around. I'm absolutely astonished by it.
JC, the GFC really helped frame, for me anyway, the drawdown, because I'd seen a huge collapse during the GFC. Then I saw a spectacular rise. And when it came this time, I wasn't as fearful, and I was actually quite excited by the opportunities. You were probably you were almost gleeful. I remember you.
Well, I was too early. I was in too early.
You were too early, but it's better to be early than not to be in it at all.
I was in too early and out too early as well. But
you're rubbing your hands together. I mean, you had a smile on your face the whole crisis. I couldn't believe it.
Well, I don't know about that. But look, I was certainly buying stocks. I mean, you know, it was unusual in that it was a totally different kind of crisis to anything that most people, anyone that has ever experienced, because previous pandemics have not had the same policy response. So the idea of locking down, you know, closing borders, locking down, people in their own homes and all that sort of thing, was just never experienced before, and people absolutely freaked, and because they'd not seen it before, I suppose. But you know, the question you had to ask is, does that justify? You know, did that wipe 30-40%, whatever it was, off the value of the of Australia, corporate Australia, if you like, because that's what the stock market said. And I think you have to take the conclusion that it didn't, and so acting was the right thing to do. But it was scary. I mean, it always is scary. And when things recovered a bit, I was running for the hills for a little bit, because I could see the debt, and I'm still worried about the debt, but maybe that's something that'll take a little while to play out. The government debt, the government balance sheets, maybe the inflation, all of that, all of those arguments take a little bit of time to play out. At the moment, interest rates are very low, and the market's very comfortable with that, and so that's why we've seen the big bounce.
I just want to add to that. I mean, I think it's not just the return of the share prices, stock prices, that's been so rapid, and that's one of the most stunning things about it. But there's also been lots of changes that are kind of psychological, in that, for 30 or 40 years, we've been told that, we have to worry about the debt. And, everybody is still worried about the debt. But, there is kind of a magic money tree that we found. It's always been there, but we've realized that we can call on it when we need to. And not much seems to change. Now, it might be that money tree can't grow to the sky. We don't know where that point is, but that does kind of change the way you think about debt in a modern society and what you can do with it. So I think there's been a psychological shift in that sense. And there's also this idea that sort of continued from the GFC, that no matter what happens, asset prices will be protected. That's one of the things that has really come out of this, I think, too. The Reserve Bank and central banks around the world have done what they can to protect asset prices, and as a way of protecting society.
I think a lot of that actually comes down to this lesson we've learned about debt. Now, I distinctly remember in the GFC, when central banks moved into action and expanded balance sheets rapidly, there was real fear amongst some investors that this would lead to inflation. I mean, the old Milton Friedman creed was, what is it, John? That inflation is always and everywhere a monetary phenomenon.
Yeah.
So if you if you raise the money supply, it's an automatic inflation trigger. I must admit, I kind of expected the same thing to happen, and when it didn't, I think that's really changed the possibilities for central bankers. And so when this crisis came about, there was a real the hesitancy had disappeared, and there was a real urgency of action, because I think the consequences were better understood of printing lots of money. I've been surprised by those consequences. I keep thinking that there has to be some cost to just increasing balance sheets massively and increasing the money supply. There has to be a price for that somewhere. I just don't see where it
Well,
is.
the cost is that it'll knock 1% or so a year off the government's finances, or however you want to phrase it, because it's got to pay the interest on the debt. It's got to repay the debt somehow, and just doing that over the next sort of 50 years is going to cost 1% a year, let's say, of GDP, just rough numbers. And so that's 1% that you can't be spending on the health service or education, and so it's a slow burn. I think there is a massive impact. The other thing is that it's just not a short-term impact, so we're sort of blind to it, and that's, I don't really adhere to that. I mean, the magic money tree seems to be there, but it's real money that's being spent, and it's money that could have been spent on fibre to the home, for example. That was, what was that, 60 billion they were talking about spending for that, and then they scrapped it, and this has cost us several hundred billion, and it narrows our options for things we do in the future. What happens if we get another pandemic in 10 years' time? We really will not be able to do the same thing again. And I just think, at some stage, those government balance sheets have got to be repaired a bit. And I don't know how long that will take and when it'll happen. But I think the easiest way that governments will find to do that will be to encourage a little bit of inflation somehow. Mind you, they've been trying to encourage inflation for 10 years and failing. So
When you spoke about that 90% thing, that's the Reinhardt and Rogoff study, I think, which said that once public debt exceeds about 90% of GDP for at least 5 years, then there's a 1% growth penalty over the long term. and we're now up to about 120. So we don't know whether that study is true or not. We're going to find
Oh,
out.
I,
But at the moment, we can't assume it's true because we haven't been here before,
well, I
really.
think you can, because it's not Reinhardt and Rogoff I was thinking about. I was just thinking of the fact that they pay whatever interest they pay or will have to pay, and also the fact that if you just say 1%, 400 billion, well, I forget the exact numbers, whatever it is, $300 billion. If you pay that off over 50 years, it's X amount of GDP, and that comes. If you just
Mm,
do that sum, it comes to about 1%. I don't know if that's what Reinhardt and Rogoff
mm.
were doing, but the you know the
I think
number.
their study was looking at economies that had gone over that
Oh, okay,
level of
all
debt
right.
and what the potential impact was on GDP growth.
But
Yeah,
the money needs,
so it's
yeah.
different, but kind of the same.
I mean, the money ultimately needs to be paid back, doesn't it? I mean, I mean, you can't just keep
Well,
growing it
that's
anyway.
the
Well,
question.
but you can't. That's the thing, growing it to the tree. I mean, and then you get
Mm,
another pandemic. I mean, ultimately,
mm.
eventually, the government will have to pay more interest on the debt. At the moment it's paying 0.1%, but at some point that'll be 1%, or and when it's 1%, then that's your 1% cost right there.
It's
Mm.
not just the debt or the cost of the borrowing that worries me. It's the genuine distortions in asset values it's created. So I know we haven't seen a lot of CPI inflation, but there's no doubt, and you go all the way back to the GFC, and you can see it, that asset prices everywhere have just ballooned, from classic cars to art. Anything rare has
Housing.
just. I wonder if cryptocurrency could have existed at any other time other than a moment of crazy central bank expansion. I think you can draw a direct line from the response to the GFC to the growth of crypto. And it worries me. I mean, look at the valuations are just mind-boggling on any historical level, but probably justified when you consider where interest rates are. But they're at a level that implies a crisis, and we're just not at crisis level. So this really worries me. Throughout history, when you've had the wrong monetary policy setting for a long time, you
Mm.
end up with massive distortions, and you have to pay for those. And the cost is not just a small amount every year. The cost is often a gigantic blow up at some stage. And I'm
Well,
just holding my breath waiting for it.
I think a good comparison in that sense is probably Japan,
Hmm.
where they've had what you could argue is the wrong monetary policy for a long, long time,
That's true.
which has protected companies that should have failed decades ago and never have. So
Hmm.
that's one potential distortion. I mean, they have a declining population, which is a struggle for them, but maybe Japan is a case where you can see the penalty in GDP terms
Hmm.
from running those levels of debts and very low interest rates for a very long time.
The other thing that's really surprised me has been the retail participation in the rally.
Mm,
Often we see retail participation often doing the wrong thing, joining the rally at the wrong time, selling at the wrong time, um, and the pros doing the opposite. And it was completely flipped this time. I saw some graphs of monetary flows, and the instos, the professional investors, were retreating at the bottom, and retail investors were piling in. And we've seen a huge retail participation, and they've really outplayed the pros in many ways. And probably the first time in my life I've seen that.
yeah, not just outplayed them, but kind of taken them on as well with all of the meme stocks. We haven't really seen anything like that before, and they're not just taking them on, but they've been winning in businesses that should have failed. But the retail investors have propped them up and allowed them to continue at the
Mm,
expense of all the people who are shorting them and obvious kinds of shorts.
mm. That feels like just another signal of that there are so many signals for the top. When you go through books, we read about all the signals. When there's blood in the streets,
Mm.
and one by one, you can just tick them all off. Huge increase in IPOs, massive retail participation, new accounts, record margin lending, record multiples, um, speculative bubbles. It's all there, and but it just keeps getting kicked along, and I'm finding it quite difficult. The hardest thing at the moment is just what to do with the gains we've made,
Mm.
and they've been so spectacular. I'm wary about sort of exiting now, because often during the later stages of the bull market is where you make some of the best returns, and I don't necessarily want to miss that. But
Perhaps we've had it.
it is, well, maybe we've had it.
Well, I
Well,
don't
that's
know.
right.
Perhaps we didn't, but I think that's dangerous sort of thinking though, because that you're beginning to play the market there. I think you've got to stick to valuation and your confidence in that valuation, and you know, quality stocks which have been bid up to very high PEs, they'll probably keep going ahead, but you're not going to get that multiple expansion anymore, and so the returns, well, I don't think, so the returns you're going to get from them are going to be somewhat more muted. Um, the weaker stocks, I suppose the point is that they can't all win, and they're all being priced a bit like they're all going to be winners, I suppose, in some of these SaaS sort of sectors. Um, but yeah, I'm treading very carefully. I've still got the remnants of a mortgage to pay off, so I'm still able to reduce and save myself. Well, actually, it's only a few percent a year now, but I mean that's the thing, isn't it? Jeez.
Yeah.
John, what do you
Yeah.
think? Is it now the time to lock in gains and retreat, or is it still offensive?
This is just one of the hardest questions in investing, I think.
Mm.
And I've never had a clear answer about it. I mean, I was editing Nathan's story a couple of days ago that we posted to the site today. Well, he kind of makes the case for holding more cash, and discusses the virtues of holding cash in a moment like this, which I can see the optionality and the patience that's needed to get through a period like this. And I have a lot of sympathy with that point of view, but at the same time, it's hard to sell some of these great businesses that we own. I mean, if I had mediocre businesses in my portfolio, then I probably would think about selling those down. But I think the companies that we've been recommending over the past 18 months, by and large, are good quality, high growth businesses that are more likely to surprise on the upside over the next 10 years. And to think about reducing your holdings now means that you're kind of making a judgment on where the market is and what it's likely to do next. And I'm just always really uncomfortable about doing that. I just don't like doing that sort of thing.
I think Reese is quite a good example because we downgraded that. I downgraded that yesterday again. So we said sell at $20,
Again.
and then it's now
Yeah.
$25, and so I said sell again. I've been hanging. The sell price is $20. I've been trying my best to avoid doing it, but eventually you have to pull the trigger. And
You
look,
do.
it's on a P. You're getting on for 50. The thing with Reese is it has to reinvest a fair bit in its business. Its return on capital is sort of 25-30%. So it has to keep reinvesting. So the cash flow yield is less than the earnings yield. So you're on a free cash flow yield of 2-3%, something around there, which is pretty low. It's growing pretty well. It's the U.S. business is going very well. It could certainly keep delivering sort of around 10%. I wouldn't be surprised. And I guess look, that's an attractive enough return, and that's the balance people have got to make. I think the quality stocks, if you're going to hold on to things, despite the fact that I've just downgraded Reese, if you're going to hold on to things, I think I always think quality is the better place to be, I suppose.
Mm.
Mm.
I suppose the other part of that, the answer to your question, Gaurav, is if you are a member who is contemplating selling Reese, you also have to ask what you're going to do with that money, whether you are going to sit on the cash that you realized, or are you going to reinvest it in some of the opportunities on the buy list? What's your feeling about that, James?
Well, that's the point, isn't it? So we can only give general advice. So we can only give, we can't say. Well, I suppose we could say sell this and switch into that. Occasionally we do within one sector, but um, I think people have to make the judgment about that. Obviously, when we're saying sell something and we've got buy recommendations elsewhere, then that's the inference, isn't it? And I think that's a fair one. I mean, I own Omni Bridgeway and I don't own Reese, for example. But that's because I never bought Reese. I got close to it, but no cigar. And I think it's a little bit dangerous at times like this because these quality stocks have done so well the
Mm.
Yeah.
last even 10 years, but the last 18 months particularly, and it's the hardest thing to. It's like trying to buy something that keeps falling. trying to sell something that keeps going up is pretty hard too. But eventually, I suppose if you buy a quality business like Reese on a P of 20, then you have that higher earnings yield, free cash flow yield. You have the potential for a multiple expansion, and the company keeps trotting along, same as ever. But when you're on a P of 50, that multiple expansion is less likely. Indeed, there's more of a risk of a contraction. The free cash flow yield you're getting to tide you over is less. So the risks change, the value equation changes, and at some point, I think you do need to act and try to find things which are better value. We've got things on our buy list which we like. Whether you then sit in cash, I have a bit of, as I've said, mortgage to pay off, which makes the calculation slightly easier for me in terms of selling things. But sitting on cash, I've always been reluctant with money that you want part of your investment portfolio. I'm always reluctant to have that. It's the old Peter Lynch thing of being caught with your trousers up. But geez, I can't stretch that metaphor. But the I don't know, the trousers have been up the last couple of years, haven't they?
I think this could go all
Yeah,
horribly wrong.
let's
So,
move on from that.
The conclusion is that I think the hardest thing in investing right now is to sell Reese and go and buy Magellan.
Yeah, well, there you go.
It is getting harder to find ideas as well. You can see that from the slow addition of new buy IDs from us. It's often a sign. It's amazing how we don't intend to do it, but when our buy list shrinks, it's a good sign that the market's getting a bit expensive, and as it expands, it's often a sign that look, this is probably a good
I'd
time.
say that's been quite a good, not meaning to
it's been a
blow
great
our
indicator,
trumpets,
hasn't it?
but has been a reasonable indicator the last
I'd say over the last 10 years, it's been a great indicator. Yeah. And I don't know how many buys are on there now, but I know it's
Not
getting
as many
awfully
as there
hard
were.
to not. Well, that's right. I think that we had a
13,
record
I think.
13. That's more than I thought, actually. Yeah,
Hmm.
yeah. But there was over 30 18 months ago,
Yeah.
and so it's shrunk a long way. And we've been looking awfully hard.
And some of the stocks that are on the buy list now have been there for quite some time, so we're not adding to them at a great rate.
Now, the buy list, John, is actually a great segue to come back to the top 3 for 3, because this year you asked us to introduce a new inclusion. Each of us introduced a new inclusion, in fact. And I found it quite easy to do that. But I suspect the others found it harder because they don't want to buy coal. JC?
Yeah.
Oh no, I found it pretty easy.
Oh, you found it pretty easy, did you?
I
What did you add? What did you add?
Omni Bridgeway was mine.
Of course. All right,
But I mean,
okay.
look, I've found a couple of things to buy myself. I mean, this is what I always go for in this competition. Is the sort of it really comes down to the 3 stocks I've been most likely to buy recently, or most thinking about buying recently, and then the same for the edition this year. So Omni Bridgeway and MVP are my 2 most recent additions, and it's a bit of a toss up between those 2. I like them both. Omni Bridgeway just has that benefit of being a little bit counter cyclical. I wouldn't call it counter cyclical. I'm not sure it is cyclical, but it's separate from the stock market in as much as it depends on legal decisions rather than on how the market does. So if the market goes belly up, then hopefully Omni Bridgeway will keep doing its thing.
Well, that's actually one of the secrets from. Well, that's one of the things I kind of changed this time around. In previous years, I've tried to do what I think is sensible or what optically looks sensible or the thing that might get me over the line. And this year, I just went with the stuff I personally own and personally had been buying. So the stuff that I included in the portfolio is 3 of my top 5 holdings that I own personally. And I just thought, look, that makes the most sense, and it's the simplest and easiest to justify. And with my new inclusion, I did the same thing. I just did the last thing I've kind of been buying, which is Whitehaven Coal, which I think. Look, I might be. I want to be open to the fact that I could be horribly wrong about this. Maybe the market's right. No one wants to buy coal. Maybe that's the right choice. It is declining, and it could decline faster than what I'm anticipating. I've got a long history with commodities. I may be tainted by that history and stubborn to change my mind. Goodness knows that's not an impossibility, but I can't understand the valuation here. To me, this seems ludicrous. I've been talking to a couple of brokers and fund managers, just trying to get what consensus is, and trying to understand what others are thinking, what the other side is thinking, why no one else is buying it. And from what I've heard from
Mm.
a couple of brokers and a couple of fundies that they don't feel comfortable buying it for their clients or for their funds because of the ESG implications.
Yeah.
But intriguingly, they are buying it PA.
Is that
One
right?
broker told me that all his clients are buying it on their personal accounts, not for their funds. And another fundy told me, yeah, we've got analysts buying it, buying coal and non ESG stocks, not specifically Whitehaven, I should add, just non ESG stuff on their personal accounts, but they
Mm.
can't buy it for their clients or for their business
I think it's
because it
sorry. Go on.
it ruins the fund optically. Sorry, go ahead.
Sorry, I was just going to say, I think it's not just the ESG thing. It's just difficult to make a case for it. If you go and have a meeting with your big
Mm,
client and
yep.
you got a couple of coal stocks in there, then they say, "Why have you got coal stocks in there?" Because coal's going out backwards, and then you got to sort of explain blah 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 and cash flow yields, and and it's a difficult argument to make. It's much easier to make arguments about stocks that have been going up the last 18 months. Um,
Yeah. And the extraordinary valuation I don't think is an adequate defense, because in commodities, in resources, you generally sell stocks at very cheap optical valuations. I mean, we sold Fortescue and Rio at what looked to be super cheap valuations, and that was ultimately proven to be the right decision. Um, and the same case could be made for Whitehaven. I think one of the brokers said, well, everyone knows, the clients know that you sell resource stocks at low PEs, and so if we start buying them at these PEs and it doesn't work out, we're just going to look like idiots. And I think that's probably correct, and I think we risk that very same conundrum. But fortunately for the subs and for the team, I have a lot of history of looking like an idiot, and I have no problem with it at whatsoever.
I think
So,
you're selling yourself there, Gaurav. You've actually got a very good history of picking this kind of situation
yeah.
with iron ore twice, I think. And
after looking like well, you have to look like a fool for some portion of the time to be
right,
Yeah,
right.
well,
yeah,
that's
that's right.
taking that's what the taking the risk is all about. Yeah, but that's the value of the top three for three contest, I think, isn't it? That's really why we do it, because it enables stocks which may be too small to recommend. Not necessarily our usual thing, but it gives a flavor, gives an idea to people of what we're personally individually favoring.
Yeah.
Hmm.
Well, Globe was the standout over the last year, and it's an idea I need to give Greg credit for, because he brought it to all of our attention, and we
Hmm.
did some work on it together. And I spent some time working on it by myself, and it was interesting. I think I was the only one to buy it at first, but I think more analysts have
Yeah,
kind of
I think I paid
jumped
twice
on
what
board.
you paid, but
Well,
the
I think you may well have done
yeah,
that.
but
Yes.
look, it's still doing all right. But it's
It was funny.
incredibly illiquid, and that's why we're not able to
That's
recommend it in the
absolutely,
newsletter.
we
But
just
we
cannot.
talk about
Even
it from time to
personally,
time.
it took me months to get my position set, months, and we just can't recommend that kind of business. It doesn't do anyone any favors, I don't think, recommending it formally. It distorts the price. People won't be able to get in. Yeah, there's a good reason why we don't do it, but it's a perfect thing for the top three for three. I actually distinctly remember when I bought it. Hoff and I went to a wedding of a mutual friend, and we were. It was raining the whole wedding. It went over 2 days, and we were in a cabin together, and it was raining with our wives, I might add. But it was raining, and our poor wives kind of got pushed to the side while Hoff and I kind of worked on stocks together
That's
during the wedding.
a classic Greg wedding
It
attendant
is a classic Greg way,
activity.
exactly. Yeah, yeah. And we came out, and I think I bought Globe the next day, or as soon as we got back to town. Yeah, it was something I
I'm
won't
going to
forget.
the wrong
Do you think he
weddings.
did that at his own wedding?
Best wedding
Yeah.
ever.
Jeez.
John, we've had a few people, one person, but I think there would be many, many more wondering why you're not into this competition and what you might be doing. You are the
Hmm.
founder of this fine business and something of a mentor for all of us. So this is your chance. Why aren't you in it? And what would you do?
Well, I think that the licensing probably stops me from doing it.
Oh, okay. I didn't know
Otherwise,
that.
I
Okay.
would. I
Right.
might check that and do it for the next one. But
Yeah,
yeah,
I would
that's
love
the
to
reason
have you
you
on
guys
board.
have a different, and I have a different kind of
Hmm.
license restriction from you guys because
Okay.
you have all done your
RG146. Yeah.
RG146 and I haven't. So that's the reason for it. I did want to mention something. I just want to ask you a question about Whitehaven Coal, though, Gaurav, because
Yeah.
I actually bought that when you first recommended it,
You mean at
and I
98
was walking
cents?
around Byron Shire just feeling so guilty. Yeah, well, somewhere around. It was pretty low,
Yeah.
and and I was walking around Byron Shire with all of these judgmental people, perhaps knowing maybe if they found out I owned a coal stock, could I really do it? Now I've moved down to Melbourne, I have less sort of restrictions, and I'm thinking maybe I could have a second bite at this. But the situation, the situation you describe, and I'll read the paragraph from the story about Whitehaven where you say the current share price is ludicrously cheap, but even if it doesn't move, dividends will make up the shortfall.
Hmm.
Whitehaven feels like cheating. And just that paragraph there reminded me of RHG, the former Rams Home Loans Group.
Oh, yeah. Yeah.
And so this was in the GFC, it was making these home loans out of a big mortgage book,
Hmm.
and the global financial system sort of seized up, and there were these huge concerns over whether it could roll over all of its financing to continue with these loans, support its loan book. And Steve Johnson did a lot of work on that business. And over the months, it became clear that there were just no defaults on its loan book, and it didn't need to roll over finance. Everything was or the money that was coming in was there and was going to continue to come in.
Hmm.
And but the sentiment was so much against the idea of a finance business that needs to go offshore to support its business.
Hmm.
Um, it was so much against those kind of businesses that thing fell from 150 down to about 5 cents.
Yeah.
And Steve, I think, sold everything he owned to buy as much as he could of it. And this kind of feels similar. You've got a business that's continuing to perform really well, but sentiment is just so much against it. It's like it's being ignored. All the
Yeah.
facts that the business is producing are just being neglected and completely ignored.
I guess the difference is you do have, well, maybe it's similar actually, because because that receivables book was in runoff, and I
Hmm.
would say this resembles a business in runoff
Right.
because you have a limited amount of time in which to extract cash
Yeah.
reliably. I mean, the coal could be around in 20 or 30 years, maybe, I don't know, but there's a good chance it won't. So, you've probably got 15 years or so. Maybe you might have 20, but sort of 10 to 15 years to extract as much cash as possible. So you really want a really low multiple. You need to have high free cash flow to justify an investment. But geez, you've certainly got it. I
Hmm.
mean, I think when I did that, the free cash flow yield was about 50%. And there's a free option in there as well. Whitehaven has one of the only. Yes, let
What
that
was I
sink in for a
thinking? Why
second.
the hell did I let my emotions overrule my head?
And and look, we're talking about Whitehaven, but New Hope is in the same boat. New Hope is
Hmm.
arguably even. It could be even. It's definitely the more sensible choice. It could be even better because and I own both. I should add, I own both Whitehaven and New Hope. Whitehaven has the bigger upside because it has more operating leverage and financial leverage, and that's why I'm kind of been talking about that. But New Hope has about half its market cap just in franking credits. It has I think the second or third lowest cost mine in Australia, super high quality, the best management in the industry, and a mine as simple as it gets. A big piece of machinery just running 24/7, digging it out. Like coal does not get easier or cheaper than this. And so, if
Hmm.
you're worried about some of the risks inherent in Whitehaven, and there's certainly specific risks there, New Hope with sort of 40 to 50% of its market cap in franking credits. I mean that thing is, and
What's the
and
free
and
cash flow
insiders have
yield
been
of New
buying
Hope?
that. It's also
Right.
50%. It might be a bit less than that actually, although they do generally make more free cash flow than
That
Whitehaven.
depends on
So
a
it's
on a
probably
particular
yeah.
coal price, though. Yeah, but the coal price,
Well, I'm talking about it. I'm talking about at spot.
yeah,
Yeah,
at the current spot price.
yeah. At the
So
current
you'd
spot
have
price.
to
Yeah.
think that
At
to not justify an investment, you've got to think that the price of coal's got to go down.
well, even when you normalize, and I've normalized it to around 70 US dollars, which equates to about 100 US dollars with costs of about $60. So you make a $40 margin for New Hope, a bit less for Whitehaven. But even then, you're still looking at sort of 20% free cash flow yield
Is there a futures
for New
market
Hope.
for coal? I mean, there must be a futures market, isn't there? And so what would be the 2-3 year? I mean, is the market predicting a big price fall?
Look, I don't know. They're not all that reliable.
Yeah, it's not a liquid thing, is it? It's
Yeah,
not
for
like
these
oil, is it?
commodities.
Yeah,
That no, and even for oil, it's not all that reliable.
right,
Those things change very quickly.
right.
I've been looking at sort of the capital going in and the capital going out. There are now moves to increase production out of Mongolia and China, but they really produce shitty coal. Sorry, I mean crappy coal. I mean bad coal.
Bad coal.
Suboptimal
Yeah,
coal.
I mean not yeah, it's suboptimal coal. Yeah, which is not going to cut it in Japan, Taiwan, and Korea, where these new generation power plants I expect to be running for longer than people think because they're about the equivalent of gas-fired plants. They're not as bad as the old school plants.
So let me just ask you one question then, Gaurav. If you are a member who likes the idea of buying two coal stocks on free cash flow yields of 50%, I've mentioned this quite a few of us, but just feel dirty about buying coal, can you make an ethical argument to support these businesses through the transition to renewables?
Absolutely. New Hope has been quite vocal about, and I guess Whitehaven, they both have made the case. And I think it's a sensible case. If we're rational about this,
Hmm.
like I am agreeing myself, I mean, I don't want pollution. I've been advocating for a carbon tax for about 20 years. I
Yeah.
used to work for a think tank, and we argued for a carbon tax for about 20 years. It's the sensible thing to do. Why should all these corporations and generators pollute our planet for free? I mean, they should pay, and the market will sort out a mechanism to lower it. I mean, it's the solution is actually very simple. It's not hard, and it's very sensible, and I think it should happen. But it's just switching off coal within a few years is a stupid solution because coal doesn't provide pollution and nothing else. There's a real utility in burning coal,
Hmm.
and we need it, right? So the
Yeah.
answer is not to switch it off over a short time frame. The answer is to phase it out, and you need price incentives to do that, which we don't have. So
Hmm.
again, the way we're doing it is stupid, and I want coal gone as well. But these guys produce super high quality coal. It gets burnt in these new generation coal plants called supercritical coal plants. They burn it at really high temperatures, and it releases less emissions and less pollutants into the air, about the equivalent of a gas plant. And if you don't fund and support these miners, those plants don't stop working. All they do is switch over to crappier, dirtier coal, and you actually increase your emissions overall. So the sensible thing to do is to support the higher quality coal miners, get the brown coal, the lignite, the crappy coal out of the market for a period of time.
Suboptimal coal, you mean?
Sorry, suboptimal.
Yeah.
Yes, yes. Sorry, yes, yes, yes. Yeah, get them out of the market for a time. Yeah, that's the way. That's the way to do it. And I tell you what, if I hear one more millennial, I think technically I might. If millennial means you're born in the '80s, I think I'm one as well. But if I hear one more complaining about investing in coal when they're running off buying Bitcoin, which generates far more environmental damage for
That causes the
zero
demand for the coal-powered power station. Power station.
for zero utility, at least with coal, you get something back for it. What do you get for crypto other than horrendous energy consumption and the madness of youth?
How much,
Hmm.
just quickly, how much of the coal that these guys at Whitehaven and New Hope produce goes actually to making steel? Do they do none of that?
So New
Because
Hope
that's
does
an easy
none.
argument.
Yeah, New Hope does none. Whitehaven does a small percentage. It's
Ah, so
probably
it's small,
less than
right? Okay.
20%. Yeah, yeah,
Yeah, yeah.
yeah.
Because
But
we're going to need more of that.
mm,
I
but
think we should do an article on the ethical case for owning these coal stocks.
Wow. Okay, that's interesting.
Because I think that's a sound argument. It's also not politically tenable just to turn off coal-fired power stations. I mean, that's not going to happen. And if you can make the argument that the substitute product for coal that these two companies produce is worse for the environment, and there is no path towards rapidly rolling out renewables to replace coal over the next few months, then it's quite a strong
I
argument.
think
I'm buying it anyway.
if you can actually, I mean, I hadn't quite realised it was as clean as you're saying in comparison. Being similar to gas, if you can produce reliable evidence for that, then the arguments become very much easier, don't they? Because we need a lot of gas. That we're not going to switch to solar cells overnight.
No.
Yeah. No, okay, that's interesting, John. I might look at that in the new year. I'm a bit scared to write it. I mean,
Yeah.
I know we're only talking amongst the three of us, so it's
Yeah,
fine
no,
to express these
That's
views.
right. That's right.
But I think you're dodging the real question here, John, which is, what would you add if you could add something to the comp?
Oh, I mean, if I was to, I think like Graham nominated Money Me,
Yeah,
and I really like that stock.
yeah,
Mainly because it presses all of my buttons. In the user experience is just absolutely fantastic. The customer reviews are amazing, and it's the kind of business that we might have missed in the
yeah,
past because it's not doesn't have that conventional competitive advantage. Like the market for short-term loans is very competitive, but when you've got Google reviews like they've got, and they're just glowing. Um, there's a possibility of that business being substantially bigger over the next 2 years of this competition, I think. And their car loans product is just going
that
through the
is
roof.
gone
So I think that would be
bonkers.
one, because that could grow really rapidly between now and the end of this competition, I think. So Money Me would be one. What else would I go for? I just
Just on
don't.
Money Me for a moment. So I own
Mm,
that stock as well,
mm,
and like you, John, I think we may have discussed it actually, but yeah, the unusually for this industry, there's a fair amount of customer love for the product and the
yeah,
innovation coming out of there. I mean, the guys are just disrupting left, right, and center. This auto product has gone bonkers. They released a fantastic numbers updates for it. There's a lag. The accounting profits are quite complex to decipher, and there's a huge lag between the loan being made and the cash flow being collected, which is part of the industry. So I think the profitability is actually quite hidden in the company, and that might explain why it's gone nowhere.
right.
But I think I
Yeah.
agree with that. I think it's a cracking business. I've been really impressed with it.
Yeah, that auto pay product is 100 million. And I think when we
Mm,
first looked at it, um, I think the first figure they reported was 8 million over the first seven
yeah,
weeks.
and they haven't even advertised or anything.
Those numbers aren't quite correct, but no
Yeah,
advertising. It was just, and that was still probably in lockdown.
yeah,
And now it's 100 million after 8 months.
mm,
So it showed there's just a really rapid pace of growth in that business. And it's also, I think it's also because the management is quite innovative, as you say. There's the potential for a lot of things to go right there, as in other product lines as
mm.
well. So I would choose that one. I've had the green whistle many times for my bone marrow biopsies. Whenever I speak to my oncologist, he asks me about stocks I've been buying, and I tell him about medical developments, and he goes, "Oh, that's rubbish. That's rubbish. That drug's so old." And I think a lot of people miss the fact that it's a delivery mechanism. That's the interesting thing
Yeah,
about it. So
that's right.
probably think about that.
Yeah, and it's a crack
James,
team.
you own that, don't you?
Yeah, I've
That
got that.
management
Yeah,
team
it's
Yeah,
a
is
great,
great.
great
Yeah.
team,
yeah.
CSL. So the management team there is
Mm.
excellent. Experience Co. I can't really get my head around. I've got a friend a skydiver who worked for them and broke his leg a couple of years ago on a hard
Right.
landing.
So they got a lawsuit on their hands,
So
do they?
I think they might have. But I'm a big fan, like Nathan. I'm a big fan of Frontier Digital. So
Mm.
that's a possibility too. I think so. They'd be my three, maybe.
Yeah. Geez, you'd be pretty close to. You might be. Might be close to beating me, John. They're great picks.
Oh, but
Glad you're not in the competition.
that's
We're
a
a year in.
year.
We're a
He
year
didn't
in.
pick him a year ago. Yeah, well, he might have. I mean, I'm not saying. Yeah.
Yeah, we did have this spreadsheet in front of me showing all of your returns, a year ago.
So you'd have picked Globe, obviously.
Yeah.
All right. Well, I think we better round it off. I've got a couple of stock picks for the new year. Bit of a reflection about what's happened, and we got to hear from John Addis, which we rarely get to do. So, John, I'd like to have you on more often in the new year.
Sure.
Excellent. Sounds good. But for the moment, gentlemen, have a lovely break. Thanks for joining me. We should also thank our producer, Stephanie, who works a lot more than we do when we do this podcast.
Tirelessly.
Yeah, make sure everything
Yeah.
sounds good
Honestly,
and
yeah, that's
works.
right.
Yeah, thanks,
I know,
Steph.
and
Yeah.
puts up with all our shenanigans.
Whinging.
I expected her to say something, but no,
Technology
she's not going to say anything because she's not
troubles.
mic'd up. Of course not. Okay, well, I'm sure she's nodding her appreciation.
She's asleep,
She-
Gordon.
more likely.
Once we start talking about
Yeah, the
coal,
hard
work
that's it. She
starts.
just stretches out on the floor, and you don't see her for a couple
Yeah,
of
much
hours.
like
think her-
the audience, I suspect.
Her hard work starts when the recording ends and she has to make us sound good.
Well, let's get her to work then. JC, thanks for your efforts over the year. It was great to have you on board. You've been on, I think you've been on more podcasts than almost anyone. So I appreciate
Apart
your
from
time.
you, but
Apart from me,
yeah, thanks and happy Christmas, everyone.
Wonderful. Thanks you.
Yeah, happy Christmas. Enjoy the holidays, everybody. Thanks a lot for your support over the past 18 months, especially. It's a different environment now, and we're going to have to get our heads around that next year, but it's going to be an interesting one, I think.
And John, we're back in early Jan.
Yeah, I'm taking
Okay.
January off, but we have light coverage resumes, I think, on the 10th of January. And then we're all back on board early February. And it is important that all of us get that time over Christmas just to sit back a bit and do some reading and think about the year ahead, rather than just having to report on the latest news of the various stocks that we're covering. So it's a time not just to recharge, but to rethink things as well. So we all have to come back with I wouldn't say a different attitude, but just a refreshed kind of mental headspace, because it's been very draining, exciting over the last year or two. But yeah, we need to come back, I think, in a refreshed, but also with a slightly different perspective as to where we are and what might happen
Well,
next.
just on that note, very quickly, what are we reading over the break? If we can do a little round robin. John, what about you?
Oh dear, I've got a load of books I've got to read. They're novels.
Yeah, me too. I'm doing novels as well.
So I'm reading novels over Christmas. I'm going to try and stay away from finance for
same.
2 or 3 weeks. I'll read the normal magazines that I would, and the websites that I would normally go to. But yeah, I just like to broaden my mind away from finance for a couple of weeks. I've also started on a book called Stalingrad.
Oh yeah, I've read that. Bit of light reading.
What do you think? Bit of light reading, yeah.
The perfect beach
After I
novel,
read-
beach book.
That's right. Yeah, so, my new next door neighbour, he's got a Polish background, so we were talking about, how the Poles really got done over 2 or 3 times in the Second World War by just about everybody last night over a bottle of wine. But it's a fascinating and extremely well researched book, and it just gives you a perspective of the war that you don't really get, from that on the ground personal experience. So I could recommend that if you're interested in that kind of thing.
It is surprisingly
that kind of
riveting.
history.
I don't like war stuff at all, but this was, I must admit,
No.
I was riveted as well. It's fantastic.
Yeah. Who's the author? What's
Is
he
it
called?
Beaver?
Bevoir or
Yeah,
Beaver? Yeah, something like
he's done a few of those, and he's done it before as well. I started his second book, couldn't get through it, but it's really, really good. Second it. JC, what about you?
So I'm on novels as well. I think we're always a bit obsessive reading all the financial news and everything, and with COVID and everything, it just sucks you in. You can get a bit obsessive about reading about all the restrictions and the vaccines and all the everything, and trying to figure out where it's going. It does your head in.
I half expected you to
even though I've
be
stopped
reading-
trying.
I
What's
half
that?
expected you
What
to
about
read
humidity?
meteorology books, JC. You become a bit
Oh
of
no. Well, look, I until this year actually, I've been most of my reading's been sort of factual, sort of
Mhm.
books about interests like astronomy or music and things like that. But I've really got into novels this year as a sort of bit of an escape, a bit of downtime. I plan to do plenty of more of that over Christmas, and it's been so Bernard Cornwell has been my go-to this year, and he's a writer, English writer of novels sort of set in English history. A lot of them, 13, I think, a series of 13. It's called the Saxon Chronicles, I think they're called, but they make up a Netflix series, or half of them make up a Netflix series called The Last Kingdom, which is what sort of got me started. But he's also written a bunch of series on King Arthur, and then called The Warlord Chronicles, I think, and then one on the around the Hundred Years' War. And they've got sort of fictional characters. Stonehenge as well. He's got one, and Agincourt. Um, and they've got fictional characters, but they're, I think, reasonably accurate to the culture, the sense of the time. So
Mm.
I've been really enjoying that. It's a fascinating period of English history, and well, periods. I mean, it goes over 1,000 years. What I just said, um, and it actually leads you into doing a bit more research about the Hundred Years' War and everything. I mean, bit of pandemic aside, we've got it. Well, actually, the Hundred Years' War leads into the Black Death, or it has the Black Death at the beginning of it, and now that was a serious pandemic. So yeah, interesting context.
It's interesting that we're all
Mm.
leaning towards novels. I am as well. I think this is, I've discovered this a few years ago actually, that you can overdo it with finance and nonfiction. And I find fiction, it really does. I don't know if it helps my investing, but it definitely aids the function of my brain. Uh,
Mm.
and I do
Helps the
actually
writing
find
as
the book
well.
definitely helps the writing
Definitely helps the
without question.
writing.
Yeah.
I think, yeah, that was a key part of, all of the training that we have when a new analyst comes on
Mm,
board. I resolutely pushed the idea of reading
yeah.
novels because analysts tend to get sort of deprogrammed in terms of their imagination
Mm,
and their ability to express
mm,
themselves on paper. Finance has a sort of dulling effect on that part of their brains, and novels was one way of kind of triggering it. So I think it's really important to not just have a break from it, but just to immerse yourself in other worlds, I suppose, which is what novels allow you to do. And there's a kind of a mind expanding component that can help you see the real world that you currently exist in, and the finance world. It kind of feeds into it, I think, and helps you see things in a different kind of way. So I'm a big fan of novels as improving our skills as investors.
Well, you'll be pleased to know I'm reading the dorkiest novel ever. I'm reading book one of Wheel of Time, which I've wanted to do for a while, but it's the hardcore high fantasy, which won't suit everyone. But geez, if you're into it, it's great. Um, Gents, we've gone a bit over time. Let's leave it there. Thank you again for your time, John. I didn't say a proper goodbye to you, but happy Christmas, and we'll see you again in the new year.
Thanks.
For everyone else, thank you for listening, and thanks for your support. Happy holidays.
Cheers.